There's a lot of rules and formulas to calculate how much money you're going to need when you retire, but let me show you what I do. I follow a 7% rule. So if I wanted $77,000 a year for me to retire comfortably today, then what I do is I take this number and I divide it by 7%. And that tells me that I would need $1.1 million today to be able to fund my retirement. And the way that I come to this number is I know that if I take this $1.1 million today, I can invest it into some assets that are going to pay me 7% cash flow, not potential growth, 7% cash flow, meaning an income being deposited into my bank account. Then I can take the 7% cash flow and live off of this income. To me, that's real financial freedom, what a lot of people like to call retirement, because now if I stop working, I know that I'll still have that income to continue doing whatever I want. I can spend this income. I know that I'll have more income coming in next year. And now if I want to keep working, it's my choice because my assets, my investments are producing enough income to do this. Let me show you what I mean. There are two general ways that you can invest your money. You can invest your money for appreciation, or you can invest your money for cash flow. Most traditional financial planning looks at you investing your money for appreciation. It means building this nest egg that's worth a lot of money when it comes time for you to retire. That way you can pull some money out and have enough money to spend until you die. This is where many people follow what's called the 4% rule, where when you have this big nest egg, you'll be able to spend 4% of this amount of money, this huge sum of money every single year, and this will be able to fund your income for retirement until you die. So for example, you build an investment account worth $1 million. Now what you can do is you take out 4%, which is around $40,000, not around, it is $40,000 today, and then you can continue adjusting this with inflation, but now you pull out $40,000 to fund your expenses, and then you pull out some more and some more and some more. This is what most traditional financial planning is, where you're working to grow this number. That way you can just pull a little bit of money out every single year. And if you then follow this 4% rule, it should fund you for the next 30 years of retirement. But that's not the way that I like to do things. My goal is to generate cash flow and income that I can spend. That way I can spend money without having to sell my investments. That way I can just keep working to grow the cash flow when I'm younger, and then I could pass on these assets later on, or kind of do whatever I want with them later on. If I wanted to sell them, I could, but I want to be able to have an income instead of having to sell investments in order to fund my lifestyle. This is what cash flow investing is all about, and it works very differently than this appreciation investing. Let me explain. But before I do, I want to remind you that on August 15th, 1971, the United States dollar was taken off of the gold standard, which changed the way that our money worked forever. And because of that, this August 14th and 15th, 53 years later, I am hosting a live investor summit. It's completely free, where I'm going to be going over a couple things. Number one, I'm going to go over how money has changed, not just over the last 5 decades, but also over the last 5 years. And then I'm going to go over how investment opportunities have changed and how you can build wealth in this new economy, where we're still seeing the impacts of inflation, where we're still seeing the impacts of higher interest rates, and now we're starting to see a slowing economy. How can you build wealth, and how can you catch financial trends in this economy? So if you'd like to join me on this free live and virtual investor summit, I'm hosting 2 workshops, one on August 14th and one on August 15th. They're live. I would love for you to join me, but you have to register, and I got the link for you down in the description below. Just make sure you do it soon, because there's a limited number of people that can actually join me live. The way cash flow investing works is a little bit different. The way it works now is you're going to work to invest your money into this asset. This square is going to be an asset. And then you're going to work to have something that's going to pay you income without having to sell this investment. What can this investment be? Well, the 2 most popular ones are, number 1, dividend paying stocks, and number 2, rental properties that pay you with cash flow. Now, the difficult part here is, number 1, getting started, and number 2, understanding how you can actually build wealth. The number 1 reason why a lot of people get turned off by this idea of cash flow investing is because it is so slow in the beginning. I mean, the first few years of you doing this type of cash flow investing, you're going to see pretty much no returns, where it's going to seem like you're not getting any cash flow, which you're not. I mean, that's what happens. If you invest in a stock that's paying a 3% dividend, I mean, you can invest $1,000 today, and after 12 months, you're only going to make $30. It's not a lot of money. It's not going to change your life. It's going to take you a very long time to build any sort of real sustainable cash flow. The second part to this is people have concerns about taxes. Because if I invest for cash flow and I'm making this income, you have to pay taxes on that income. which is slowing your potential growth. Versus if I invest my money into a company or into this thing that's just growing in value, you don't pay taxes when something grows in value unless you sell. Like if you bought a home for $500,000 and now that home is worth $2 million, you don't pay an income tax on that growth in value. You got to pay property taxes, but that's a separate point. You don't have to pay an income tax because you don't actually have an income on your new equity. You only pay an income tax if you were to sell. So if you buy a stock for $100 and then it goes up in value to $10,000, you don't actually have an income, so you get to control the tax bill. Versus here, if you buy an investment, whether it's real estate or stocks, and it's paying you with income, you got to think about taxes because now you got to pay taxes. Now, the nice thing here is that you do get to pay lower tax rates or get higher tax deductions on this income that you're getting from your cash flow from investments. I can tell you this as an attorney who is not your attorney, but our tax code has special tax loopholes or special tax breaks for investors, but you still have to think about taxes. And then when it comes to cash flow is, well, it's something that you're going to have to manage as well. See, when it comes to cash flow investing, in order for this to work, this is something that you're going to have to stay consistent with and keep investing in for a long period of time. Now, there are two different ways that I invest my money for cash flow. I invest my money into real estate primarily, and then I invest my money into dividend-paying ETFs, high dividend yielding funds for the cash flow. Let me start by talking about real estate. The way that I underwrite my deals is I look for a property like this that I know is going to pay me a 7% cash on cash return. What that means is, let's just assume that this property sells for $150,000. If I were to buy this property for $150,000 cash, that would mean that I would have to make $10,500 a year of profit, not rental income, but profit after paying all my expenses, my property taxes, my insurance, my maintenance, management fees, and my vacancy costs. I'm assuming I'm buying this cash just for the purposes of this example to keep it simple, but that means I have to make $10,500 a year in profit from the rental income after paying my expenses to justify my investment, because that would be a 7% cash on cash return. Now, I already know what a lot of you are thinking. Jaspreet, where in the world are you going to find properties like this? Where in the world are you going to find these types of deals? Look, if you can't find these types of deals where you are, maybe you have to look somewhere else, because I can tell you that in the Midwest, you can find these types of deals. Well, they're pretty available. I wouldn't say everywhere, but they are available. My office is in Detroit, and what I can tell you is that these types of cash flow deals are available in Michigan. Now, here's what you got to understand. When I'm making these types of investments, I'm not just looking at the cash flow, because there are some amazing cash flow deals in areas that I don't want to invest in. And this is where what's important for me is I want to make sure that I understand I'm investing in the underlying asset, not just the cash flow. I want to invest in a good underlying asset that's paying strong cash flow. And what that means is when I'm investing in real estate, I want to invest in an area that I believe is growing. So what I look for, number one, is a neighborhood where the population is growing. Because if the population is growing, that means more people want to be there. There's more demand in that area. There's more employees that want to work there. There's more businesses coming in. More people want to be here, more businesses, and more money is moving in. That's what I want to see first. Because if the population is falling, well, that means the potential demand to use, live in, rent, or purchase my property is falling. I want to be in an area where the demand for my property is going to be rising, because that's also not because that could increase the property value. That's not what I care about. That's not what I look at. Because that can increase the rental income, which can increase my cash flow. That's what I make my investment decisions off of. If property values go up, great, that's icing on the cake. If property values go down, oh well, I'm still getting my cash flow. That's the way that I make my investment decisions. So I want to be investing in a good underlying asset in an area that I believe in, where I think businesses are moving into, where I believe people are moving into, where I believe is going to be more valuable in the future, because that can help continue to drive strong cash flow. Now, I get it. Real estate investing is not for everybody. It is tough. It takes more time. It takes more money. It takes more headache to get started. But for some people, this is a good way for you to go. Regardless, I want you to understand this though. The beginning part of starting as a real estate investor is not passive. It is a big pain in the butt. You're going to have to meet a lot of people. You're going to have to fire a lot of people. You're going to have to learn the ropes. You're going to have to find good contractors. You're going to have to find a good property manager. You're going to have to figure out how to manage a property manager. And you have to figure out how to just control and operate this whole thing. But once you figure it out, once you find good team members, once you get slapped in the face and lose some money, well, then it starts to become a whole lot easier, because you've already made those mistakes. And hopefully you'll stop making the very expensive and painful mistakes once you go through it a couple of times. After that, it can be much more passive, because then you can work with the property manager who then handles all of the day-to-day work for you. And then you just have to make sure that your property manager is doing the job. So this is the first way that I like to invest for cash flow. The second way that I like to invest for cash flow is investing my money into dividend-paying funds. Now, I got to give you a disclaimer. Investing has risks. You are never guaranteed to make money when you invest. In fact, you will lose money at some point. So make sure you always do your own due diligence and never blindly trust a random guy on YouTube. Everything that I talk about is just for examples. I don't recommend what I do to anybody else. This is just what I do. I want you to learn. My goal is to help you be better with money. So the way that it works for me is I have a system where every Wednesday, money leaves my checkings account and it's invested into my portfolio of funds. Why Wednesday? I don't know why I always get this question. The reason why I picked Wednesday is because it's in the middle of the week. There's no secret sauce to this. I don't care what day you pick. For me, it's Wednesday just because it's in the middle of the week. It's hump day. All right. So now I have this portfolio of funds which is investing into a number of different things. But the thing that is the largest piece of this are my dividend paying funds. After that, I have some value funds and then a little bit of emerging market and innovation funds. But the bulk of this are dividend paying funds. By the way, these value funds also pay dividends. So the vast majority of my funds are cash flow producing funds. And when I say fund, I mean things like ETFs, mutual funds, and index funds. So every Wednesday, money is invested into these funds, and then every quarter, meaning every 3 months, I get a dividend payment out of these funds. Then I take that dividend payment and I reinvest it back into these funds. That way, it's just constantly working to produce more income. Every time, every Wednesday, I buy more cash flow producing assets. Then when these assets pay me with cash flow, I use that cash flow to buy more assets. It's a machine that's on autopilot. I don't care what's happening in the markets. I don't care if it's raining outside. I don't care if you're in a recession. I don't care if the markets are booming. It happens every Wednesday, whether the markets are up or down. That way I can just keep accumulating more and more of this cash flow. But again, the same rules apply here as for real estate. With real estate, I'm looking at the underlying asset, not just the cash flow. It's the same thing when it comes to the stock market. And I'm telling you this from experience because when I was getting started, one of the things that I like to look at was how much cash flow is a stock paying? What is the dividend? And what I would look for is the highest dividend paying stock. So I would go on those forums online and look for the highest dividend paying stocks, thinking I was a genius that nobody had thought of this idea before. Then I would buy those. And what you would realize is that just because the company is paying a big dividend doesn't necessarily mean it's strong. Let me show you what I mean. Let's assume that a company is trading for $100 a share. And at this time, it's paying a dividend of $3 a share. So a 3% yield, which might not seem that attractive to you. Maybe it does. That's besides the point. But then let's assume this company starts to have issues. Now the stock price falls to $50 a share, but they haven't changed their dividend yet. Now all of a sudden this dividend looks a whole lot more attractive because it's a 6% yield. But the reason why it's a 6% yield is because the stock price got cut in half. And this is why, again, when it comes to investing in the stock market, you want to look at the underlying asset, not just the cash flow. And this requires some research on your own end. So if you're investing in individual companies, look at the asset. If you're investing in fund, look at what types of